Okay, so what's up, tribe? In this video, I'm going to explain liquidity for you. How you can trade liquidity, how you can spot liquidity in the market. Some persons try to confuse this thing and make it too complex for um for some of you. Okay, so um to put it very simple, liquidity is nothing but money. That's all. It's just nothing but money, or you could say orders, right? Unfulfilled orders. So this is what liquidity is. You don't need to complicate it. So it is my money, your money, institutions' money, right? That is in this market, essentially. So I mean, money is the oxygen of this market. There's nothing else that we're actually selling or buying. It's just money, right? Currency and value. So you could say liquidity is where money, orders, or value is sitting. So now this liquidity, how do you spot this liquidity on the chart? Now liquidity always comes at zones, zones, kilos. Okay, zones and key levels. It's as simple as that. Zones and key levels. Now there's so many zones in the financial markets that people are identified, right? Because we don't really trade the market, we trade our beliefs. We trade things that we see, patterns that we see. So these are I will show you the patterns or review the patterns um that uh that people have identified in the financial market. Okay. So liquidity are always sitting as zones and key levels. I'll give you an example of that. Now, this liquidity or these orders or value moves from supply and demand, buyers and sellers, supply and demand. Okay, so I have a course where I was teaching my students here. Okay, this is called order book, right? Or order flow, whatever you want to call it. Now, this is happen behind the scene, and chart patterns are sorry, the price is just a visual representation, right? So this chart you see something like this. Okay, so something like this is just a visual representation of orders that are going behind the scene. So this is what we call order flow, the order book. Okay, so now if you watch closely, uh, this right here are this column right here are just buy orders, right? From buyers. It's called bid. This right here are sell orders. It's called the axe. Yeah. And this at the center is the price. Okay. Now, if you watch closely, you can see that there's a lack of selling interest here. The volume, the sell orders are very, very small. Now, what buyers did was buyers came and absorbed all these orders and pushed price to 54 here, right? And above this 54, there's 55, there's 56, this price level. And there are massive orders, large orders sitting at 56, 55. Right? So buyers pushed and absorbed all these sell orders and pushed it to these large orders right here. So this area are liquidity zones, right? So you can see this right here is a liquidity. There are large orders sitting around here, right? So there's money sitting around here, there's orders, there's value sitting around here, and buyers push the market to absorb all of these orders and get to where sellers are going to push price down. So that's why market moves in waves, right? It moves between supply and demand. There's this interaction between supply, buyers and sellers, supply and demand. It's that simple. Now, now, what other zone aside from supply we have? Now, if you check, I mean, on YouTube, you will see that we have things like fair value gaps. We have things like order block. We have things like we have so these are the uh, zones or levels where we most likely find liquidity, right? So liquidity, we see liquidity at zones or key levels, and people with their years of research analysis, they have found that market moves from zones and key levels. Now, these key levels are Fibonacci, support and resistance, highs and lows. We have zones as well. Zones are fair value gaps, order blocks, supply, demand, or whatever. And these things create pattern in the market. They create chart patterns. Market moves from liquidity to liquidity. It's that simple, right? Supply and demand. Now, as market is moving from supply and demand, so let's say, so this is one movement. So uh buyers push price to this level, which I've shown you guys in the other book. Push price to this level, right? And it came back to this zone here. This could be the Fibonacci retracement. This could be support or resistance. This could be highs or lows. It could be anything. There are so many levels. Now, came here, absorbed orders sitting around here, push price to another liquidity level or liquidity zone, retrace again, and this is sorry, and this is how the market moves. Now, sometimes the market will come down like this, right, and absorb this liquidity sitting around here, because it is assumed that there's still buyers sitting around here, right? Because liquidity are always sitting at what, like I said, levels and zones. So you come here, take out this liquidity here, right? Retrace again. So there's also a liquidity sitting around here again. Okay. All right. So you could get this, right? So liquidity was sitting around here. Buyers came and take out this liquidity. This could be a zone. Now there's also a zone here, or you could say a level. Came and took out this, right? And then it came and then went down, declined down. So these right here are liquidities, right? Now you might not be trading supply or demand zone, but let's say you are trading support or resistance. Let's say you're trading support or resistance. Okay. So let's say the market came and did this. Now, this right here is support. So market is picking support from this level. So that is telling you that there are buyers sitting around this level. So once price comes back to that level again, we're looking to buy, right? So this is a level, right? This is support and resistance level. Now, this has also formed what they call triple bottom or double bottom. If you see this before price gets there, double bottom. So once price gets to that double bottom, you're looking to buy. You understand me? So this essentially is just what liquidity is all about. Let me show you an example. So look at this now, right? So sellers are pushing price down, then there are still orders sitting around here, and then buyers pushed price to where sellers are staying, because buyers are not going to push price down. The sellers are going to push price down, right? Because maybe there's another liquidity sitting around somewhere here, right? Look at this also. You see how the market is moving. It's moving from liquidity to liquidity. So there are orders sitting around here. Price came and absorbed all these orders. You can see what I'm saying, right? There's a level here. Came and absorb all these orders here and then push price higher, right? And then started going up. Now, this also, if you know about fair value gap, you can see this right here could be Fibonacci, or could be fair value gap, right? Fair value gap could be sitting around here. Fair value gap could be sitting around here. So let me show you what fair value gap essentially is. So let's say we have price doing this, right? We could have fair value gaps sitting around here. Fair value gaps mostly come when there's a massive impulse of price, right? So fair value gaps could be sitting around here. If you're that trade fair value gaps, right? So fair value gaps will see. So let me show you what fair value gaps looks like. Let me show what fair value gaps looks like. Okay, look at this. So this is a fair value gap. Fair value gap, right? We have this demand right here. So price pushed out of this demand zone here, and then it created this what we call fair value gap. So we have three candles here, one at the left after the massive impulse, and then one at the right. Now this week, the week of this one here and this one here doesn't have to meet. So this is one here, and this is another one here. So this is a massive impulse. Now the space in between these two candles is what we call the fair value gap, right? That's just the simpler terms, right? So so now you can see price came to that fair value gap. Let me go to fair value gap. Came and tap on that fair value gap, and guess what? It's rallied. And if you're trading fair value gap, right? For trading fair value gap, you could just, as price came to that fair value gap here, you could put your stop loss here, your entry here, put a stop loss here, and then you could target this high, will give you 1:1, or you could use a fixed RR, or you could target this high here, target this higher, that give you almost 1:2. Understand? So if you trade fair value gap, now if you trade zones, now this zone was failed. This is one of the trade that I took, and that was failed. I'm waiting for price to come to this level. So price came to this level, and then it starts rallying up, right? Okay. So this is what I was anticipating for the market to do. Anticipating the market to push to this next zone here, because now this demand has turned to supply, right? We have orders sitting around here. We now have orders sitting around here. This turns to supply zone, right? So market came and tap on this demand, so I'm expecting price to get to this supply zone here, maybe before pushing down to this 4-hour demand zone. So market moves from supply to demand, liquidity to liquidity. Now, this liquidity, we spot them from zones. So this is how I've been able to categorize them, because trust me, there's so many concepts on social media, on YouTube, and people just get these things confused. So liquidity is always sitting at zones and key levels, and there are so many of them. There are so many zones. I've given an example. We have the fair value gap, then we have the order block. which is same thing as supply and demand zone. We also have the breaker block, right? I didn't even mention that. We also have the breaker block. Yeah, the supply and demand, right? I'll just see here. Supply and demand, right? We have the breaker block. Now, the breaker block is almost similar to support and resistance, right? It's just similar. It's almost similar to it. It's just you're just giving a wiggle room. So let's say now you have this. Sorry, let's use this as an example. So let's say now you have this. This is a support and resistance. You could also put this as demand zone here. It's that simple. You could put this as demand zone. Okay, who is as demand zone. Now you could also say this is let's say the market did this. The market did this. This is called breaker block. Right. So this is a failed supply. I didn't have breaker block because I hardly trade breaker block. So it's the same thing with support and resistance, essentially. Right. So it's just this why they give it, breaker block is because there's a wiggle room, there's a zone being created, there's a block being created. But it's the same thing with support and resistance. So liquidity is always our market is always going to liquidity, and liquidity sitting at zones, and these zones are fair value gap, order block, breaker block, support, supply and demand zones, and also key levels like Fibonacci, support and resistance, highs and lows. And all of these things create a pattern in the financial market. You have chart patterns, candlestick patterns, and all of these things. So this right here is just a way to simplify everything for you. Right. So how do you trade this thing? Now, I've shown you guys before that if you only want to trade the financial market, don't complicate things for yourself. What you should be looking at for is what they call forecasts, is what they call forecasts, what we call setup, what we call signal. Right. Here's what you should be looking out for. So when you want to place a trade or develop a strategy or a methodology, have a methodology of knowing the directional bias, which is your forecast. What is your setup? So your setup is which zone are you entering, or which liquidity levels are you going for? Are you entering on fair value gaps? Are you entering on order blocks? Are you entering on breaker block, support or resistance? Which one? Just pick anyone. Pick anyone and do your back testing. It's that simple. Are you using Fibonacci? I'm telling you, there are some traders that just trade Fibonacci. Yes, they just trade Fibonacci. Some is support and resistance. Some is they trade I'll not say highs and lows, but they trade but essentially support and resistance. This is highs and lows, right? Highs and lows. So let's say now another example for highs and lows could be this. So let's say you trade accumulation. So let's say you trade Wyckoff theory, right? So their liquidity is sitting above these highs, here. The liquidity is sitting above these highs. So you could wait for market to break out of these highs, and once market breaks out of this high, you could look into maybe enter somewhere around here. Yeah, somewhere around here. So once market made that retest, then you look to buy from here. You look to buy from here. Stop loss below maybe that breakout block or whatever, and then you aim for a 1:1 or 1:2 or whatever. Okay, so this essentially is how liquidity works. This is how liquidity influences the market. If you have any questions, you can send me a DM on my Telegram, and I'm also hosting a mentorship program, so you can join our mentorship, and I'll teach you guys how you can trade liquidity zones, how you can profit and become profitable in the financial markets. Okay, so like, subscribe, and I'll see you guys in the next video.